Hello there. Well, after a quiet few weeks on the stock market, we've seen a little bit more volatility again recently. And that volatility has largely been caused by expectations that central banks will put up interest rates. As we've all seen on the news, there's lots of imbalances in the global economy at the moment, which is leading to empty shelves at the supermarket. We've got energy bills that are on the way up. And obviously we've had some problems getting petrol for our cars. And all of that is likely to add to inflationary pressures. Now, we still think a lot of those inflationary pressures are temporary. They're caused by base effects because prices are rebounding from a low base from last year, and by some of these imbalances. As the economies have reopened, there's greater demand for goods and services. In some cases that's actually higher than pre-pandemic levels as we're sort of making up for lost time. But supply chains take a while to catch up. It takes a while to get something from one side of the world to the other. So we have got these imbalances, but over time we think they should get better. But certainly we think inflation is going to stick around for probably the next 12 months or so before hopefully then falling back. And what that means is central banks are thinking about putting up interest rates. Now, we think they probably shouldn't be too hasty about it. Normally putting up interest rates to counter inflation works because it reduces demand. But we haven't got a problem with demand, we've got a problem with supply. And putting up interest rates doesn't fix those supply chain issues. It won't really have an impact on inflation. But we do know that they also want to get away from those rock bottom rates, which therefore gives them a bit of room to cut again if we have another downturn. So certain markets have reacted badly to that, notably the bond market and certain types of stock market. As we talked about in previous months, we've tried to protect our portfolio a bit more against inflation by having some more real assets like infrastructure and property. And we've also made some changes to our bond portfolios. So we're quite comfortable that the portfolio should be relatively well protected if that inflation gets worse than we think or doesn't fall back as quickly as we think. But I certainly think that will cause a little bit more volatility for some time yet. Thank you.